What's up, everybody? In this video, I'll be showing you how to analyze the cash flow on a rental property that you're potentially getting ready to purchase. This is going to be a very detailed video, so please just take 1 second, hit the like button, subscribe, and click the notification bell so YouTube can push this video out to a bigger audience. Now let's get into this example. So the first thing you need to do is calculate your gross income. So in order to do that, you have two branches that's under the gross income, which would be your actual income and your projected income. Your actual income is what the units are actually renting for that you're getting ready to purchase. So if it's a 4-unit property and each one of the units are renting for $1,000 a piece, that means that you're collecting $4,000 in rental income from the property. Now, when projected income come in place, that's when most of the time the seller tries to tell you, hey, it's renting out for $1,000 right now, but if you move that tenant out or you renew the lease, you can rent this property out for $1,400 a month. And most of the time, they don't have any proof that that can actually happen. They just going off of how they feel because they want to sell the property to you. So never ever take projected income from the seller that you purchasing the property from. Get that information on your own. You can use websites such as Rental Meter to see what properties are renting for in that area, or you can use Zillow or PropStream to figure out what properties are renting for in that area. So now that we have an understanding on gross income, let's go into the example. All right, so let's say that we're looking at a $400,000 property and it's a 4-unit fourplex property that we're looking at. If we rent this property out for $1,200 per unit, the gross amount that we will receive from this property will be $3,600, which will give you a yearly total of $43,200 per year. And we're not going to include this in there, but as a landlord, you can include on top of the rent storage costs or like a parking costs. So that'll be storage income and parking income. But in this example, just to keep it clean, we're going to leave that at zero. So we know that the total gross income would be $3,600 on this particular property. Now, that's not something that you could just put in your pocket. You got to calculate what the expenses is on this property as well. So we know that we're going to have property tax, we're going to have insurance, we potentially may have a HOA, which is homeowner association fees. We could have utilities, we can have lawn care, we can have repairs, we can also have management fees, and we could potentially have vacancy. Let's add all those up. So let's say that the property taxes that we pay every single month would be $316 per month. Let's say the insurance is $150 per month. And for this particular example, let's say that we do have an HOA fee that is $75 per month. We let the tenants pay the utilities. Lawn care is $50 per month. Repairs are $125 per month. And like I say, it may not be repairs at the current time, but you just put that money aside for just in case. Management fees such as property management companies, because you don't want to have to deal with tenants all the time. Let's say that's $200 per month. And vacancy, just in case, you have to evict a tenant or the tenant leaves and the property doesn't have a tenant in place. Let's say every single month we put aside $125. Your total expense for the property would be $1,041 per month. So in order to get the net income, you would just have to subtract your gross income from your expenses. So we already said that the gross income was $3,600 and the expenses is $1,041 per month. So that would create a net income of $2,559 per month. And what's very important whenever you analyzing a rental property is your ROI, which is return on investment. So in this case, we would take the net income and the total cost, so the total amount that it costs you to purchase the property and everything else that's included. We will divide the net income by the total cost, and then we will multiply that by 100. So if you're looking at the numbers, it would actually be $30,708 divided by the total cost, which was $400,000 to purchase the property. That would give you a return on investment of around 8%. Which is not bad. And that would also be considered the cap rate. But as an investor, we don't look to just pay cash for properties. We like to use other people's money. So let's tweak it a little bit. And let's say that we decide to get a mortgage on this property instead of coming out of pocket $400,000. So to figure out how much the down payment would actually be and just the total cost of everything. My favorite website to use is mortgagecalculator.org. I go there to figure out what the amortization schedule and everything is and how much it will cost to get a mortgage at 5%, 3%, 2%, whatever. You can run the numbers in there. So let's go into that. As you can see here, if I put down 20%, which is pretty much a conventional loan, on the $400,000 purchase price, we would actually be out of pocket $80,000. And let's say the loan is a 30-year fixed rate loan at 5%. So now to figure out what the net income will be, we would subtract the mortgage from the net income that we previously had. So I'm pretty sure you remember the net income was $2,559. So we're going to subtract the mortgage from that, and we would actually have a new net income amount of $821. So let's figure out what your total investment is now. Instead of it being $400,000, you had to come out of pocket $80,000. And you also, let's not forget, closing costs is important as well too. Let's say, just for the sake of this video, that closing cost is 1%. So 1% of $400,000 would be $4,000. So if you add the $80,000 plus the $4,000, your total out of pocket is $84,000. It's way less than the $400,000 that you came out of pocket on the last example that we used before we tweaked it. So now, like I said, your total income now is $821, and per year, the new total would be $9,958 per year. Let's figure out what your new ROI would be. So we'll just use the same formula, and we would divide the new income by the total cost. So the new income for the year is $9,858. So you just divide that by 84,000, which would be the total expense. So your new return on investment would be around 12%. So it'd be 11.7%. So I just rounded up to 12. That is a great return on investment, but you're leaving out a very, very important key aspect. That's why I like to use mortgagecalculator.org, because another key factor is paying down your loan, which is increasing your equity in the property. In the very first year, as you can see here, you will increase the equity by $3,064. So that'll be the equity amount for your first year. So now it's time to add your equity amount plus your income that you receive per year, and that'll give you your total income for the year. So now your total income for the year will be $12,922. Now let's get your new ROI. It's going to be even higher now. So let's divide that by your total cost, which was the $84,000. If you divide $12,922 by $84,000, then you multiply that total by 100. Your return on investment would be 15%. That is amazing. If I can pick up 4 or 5 properties like that every single month, I will be well on my way. I want the same thing for you. So I hope this video actually helped. I hope it made sense. If there's any questions or anything that you may have, please feel free to leave a comment down below and let me know what you think about this video. Do you feel like it was useful? Is there anything I need to improve on? But remember, hit the like button, subscribe, and click the notification bell. And also feel free to check out this video right here that shows you how you could potentially live for free by using an FHA loan to purchase a multi-family unit. So it's similar, but it's if you want to live in the property as well too, to just live for free. I'll see you next time.